Hey everyone, welcome back to the channel. Welcome to the second episode. This is a series where I put myself against the S&P 500. I won't be using leverage, I won't be using options. I will solely focus on stocks that are tradable on US exchanges. And we're going to try and beat the S&P 500. We started with $10,000 invested in both my portfolio and the S&P 500. These are just hypothetical numbers, and we're going to see who comes out on top. So, since our last episode, I was holding just cash. We just got started. So, today I'll be sharing with you my first buy in my portfolio. And that pick is none other than Dollar General. I bought this 2 days ago at 71.89 cents a share right before close, and is now trading at 75.51, and we're already up 5%. So, a fantastic start. Today is March 6th, and we are beating the index so far today by over 2%, so a fantastic start. And over the past week, we are actually beating the index by around 2%. So in total, we're beating the index by about 5%. So extraordinary performance so far. And without further ado, I'll go into reasons why I bought Dollar General and why I believe it is an incredibly undervalued stock, and why I believe this is worth at least $100 per share. If you aren't familiar with Dollar General, they are a chain of dollar stores similar to Dollar Tree. One big difference is that they primarily focus on small towns and rural communities. I believe this is one of the huge advantages why I prefer Dollar General over Dollar Tree. Retailers like Walmart, Costco aren't directly competitive with Dollar General because they can't afford to open big stores in areas where there aren't that many people. And Dollar Tree is focused on opening stores in large cities and urban areas. So Dollar General is really in a unique spot where they have a huge moat because a lot of companies aren't competing with them. If we scroll down to check out the price history of Dollar General, we can see that it is down a whopping 50% over the past year. It was trading at $155 just a year ago, and now it's $75. Over the past 5 years, we see the same thing. It was trading at $150 5 years ago, and today it's sitting at half as where it was before. It is only when you go back 10 years that Dollar General is pretty much flat over the past, since 10 years ago. It was trading at $60 a share, now it's at $75. So this has been incredibly beaten down. And normally I don't like to buy stocks that are getting beat down. You don't ever catch a falling knife. But in this case, I believe there's a big recovery story to be had, and I believe this drop is a great buying opportunity. If we take a look at the company scorecard, this is a scorecard that shows 5 key metrics of the company to allow you to better understand how this company is valued or how it's growing. So first we have value, which is ranked 83 out of 100. We can see that this tells us that the free cash flow yield is a whopping 10%. So this company is really cheap right now. You're getting 10% free cash flow on every dollar you put in. That's a really hefty return. If we look at the growth, it's only 15 out of 100, which makes sense why value is so high because the company is not growing very fast. We have year-over-year revenue growth of 5% and earnings decline of 29%. So this basically tells us the story of the company, which is that it's a high-value company with little growth. And then we can take a look at returns, which is the company returning money to shareholders? And we can see that this makes up the dividend yield, and also it's slightly diluting shareholders by 0.2% every year. And then there's stability, which tracks the stability of revenue and profit margins over the past 5 years. And we can see that this company is in the middle. It's not that stable. There's some variance in its numbers. And last, we have company health, which measures the balance sheet strength and debt ratios. We can see some ratios here of current ratio of 1.15, which is its current assets and liabilities. We can see its debt over EBITDA. So these are numbers all tell us that the company's in a pretty healthy spot. There's still some debt that the company has, but overall it's in a very healthy spot. Scrolling down further, we can see some ratios here. The PE ratio is at 11.8, and the forward PE is 12. So this is all below the S&P average of around 25 or so. So this is fairly cheap compared to the rest of the S&P 500. With the profit margin is razor thin at 3.33%. So let's dive into a dashboard and analyze the company further. Okay, so here we are at the dashboard for Dollar General. And we can see that we looked at the stock price over the past 10 years, and it was pretty much flat over the past 10 years. It went from 67 to now it sits at 75. So it grew about 10% over the past 10 years without dividends invested. And the market cap of the company actually declined over the same period. It went from 19 billion to now it sits at around 16 billion. So the stock price increased over the past 10 years, but the market cap decreased. And that is because Dollar General was buying back shares. It went from around 300 million shares outstanding to now just 220 million. So over the time, they were buying back a ton of shares, and just recently, over the past year, they paused share buybacks, which is why now it stays around 220 million shares outstanding. And here we can see why the stock has really gone down so much. And the company earns about $1 a quarter. It went up all the way to $3 a quarter, so a humongous growth there. And over the past 2 years, it declined, and just in the most recent quarter, it only reported 89 cents in earnings, which is in line with 10 years ago. So that basically tells us that the company is going down because their earnings are under pressure. If we look at their revenue, it paints a very different story. The revenue has actually doubled. Quarterly revenue went from $5 billion. Now they're doing $10 billion a quarter. So their revenue doubled over the past 10 years. The valuation actually went down. So this could mean one of two things, right? It looks like it's because of decline in earnings, but also could be because they're taking a lot more debt. Their balance sheet is weaker. If we look at their balance sheet, it actually looks quite strong. We saw earlier in the scorecard that the health of the company was around a 58. And we can see that the shareholder equity, which is assets minus liabilities, are actually in a positive $7 billion. The company's only valued at $15 billion, and they have around $7 billion in equity. They have about $5 billion in debt, which is very manageable, right, for a $15 billion company, and a company that's generating $40 billion in revenue a year. It's very manageable. They have about $500 million on cash on hand, and overall their balance sheet looks quite strong. So really, what took the company down from $150 a share or $200 a share down to $75 a share is really because of earnings decline. And we can see that the revenue is no problem, which means that the margin of the company has been declining. And we can see that their operating margin has declined all the way to 3% last quarter. Profit margins went from around a 6% average down to a 2%. We can see that the margin of the company has been compressing over time. And this is really why the stock is under pressure. If we look at why this is happening, we can take a look at the expenses. So here's the revenue breakdown. We break it down with the cost of goods and services sold. So in this case, their inventory and all the things they sell. And we have SG&A, which is their selling, general, and administrative expenses. And what's left of all that is our operating income. So we can see that the operating income of the company has not grown at all. Let's go to the annual view real quick. We can see that the operating income has not really grown over the past 10 years. It went from about $2 billion in 2016. It went up to $3 billion in 2022. And then over the past 2 years, it dropped back to $2 billion. Really, what's happening here is that their SG&A expenses have been growing way faster than the revenue. The cost of goods and services has remained roughly 70%, as we can see. The gross margin is 30%, which means that the money they spend on goods and services is about 70% of their total revenue. So they're spending way too much money on SG&A, which means that they have to fix this by either increasing prices or cutting their SG&A costs. So Dollar General has a problem with its profit margins. However, I still believe this is a fantastic investment because they provide a lot of value to customers by operating primarily in rural America, where there's a lot of demand for retailers like them. There's less competition from big box retailers like Walmart and Costco that don't find value in going to areas that aren't very populated. They differ from Dollar Tree's target market, so already they have very little competition, which is great for business. The second is pricing power. Short-term margin dip caused a lot of fear. I believe this isn't a problem, which I'll show later, that razor-thin margins mean that a small pricing increase can resolve the problem. The third is the tariff impact. This stock has also been beaten down because of tariffs, and I'm going to show through some calculations that impact is not as significant as most people believe it is, and the price increases don't affect all of Dollar General's offerings, only certain products. There's some risk with Dollar General, obviously, such as the slow revenue growth, or their margins are going to be persistently bad. Tariffs is also a risk, but I believe that risk is overblown. The second risk is management. Don't see management taking advantage of the lower stock price. They actually paused buybacks when the stock reached the lowest point in 10 years. So that's not a good sign, right? They were buying back shares when the stock was at its highest. And then when the stock reaches its lowest, they still have cash on hand to do that. They just haven't been buying back shares, which I believe is a mistake. The management is also too focused on new store openings instead of focusing on fixing current stores and fixing their margin problem. That's an unpredictable factor when investing in this. So we're going to make some predictions, and we're going to do a DCF. I don't have the DCF here, but I show the results here on the right side. So for the bear case, we're going to assume a revenue growth every year by about 2.5%. This is actually below the rate of inflation, which is also around 2.5%, but because Dollar General opens new stores every year, 2.5% revenue growth is basically assuming their same store growth is going to grow slower than inflation, which I think is an unoptimistic view. I'm going to assume that their margins do not get better at all in our bear case. As you can see here, margin, I am saying that it's going to remain at 3.9%. And even with these estimates, that the margins do not improve back to its historical levels of 6%, the bear case, we're still at 2% higher than where we are today for today's fair value. Looking at the base case, I'm assuming that same-store growth sales are about leveling to inflation. Along with new store openings, that gives about 4% revenue growth. And here I am assuming slow margin expansion to where it was historically at 6%. So I'm going to say that's going to increase from 3.9 to 4.6 next year, and then 5.4, and then 6.1, and it's going to stay at 6.1. So given that this scenario happens, it's actually an 80% upside. And finally, for our bull case, we are assuming some revenue growth in addition to inflation. This is actually historically accurate. Dollar General has grown their revenue at rates around 8 to 10% per year. So 5% is not out of the ordinary at all. And here I am assuming that their margin is going to go all the way to 6.7%, their net margin, which is a little bit optimistic, but this is where historically it was. DCF really shows how undervalued this company is, and this is why I believe this is the most likely outcome. I don't believe the tariff impact on consumer prices are going to be that significant, and here I'll show you why. Let's say there's an item at Dollar Tree that sells for $1. As we discussed about gross margins, a $1 item at Dollar Tree would roughly mean that the item costs about 70 cents to import. With a 10% tariff, which is what Trump enacted on China, the item is going to import at 77 cents. Given the 25% tariff on Canada and US, any goods from there will import at 88 cents. When we add up the selling, general, and administrative expenses of 25 cents, which don't change because they are unimpacted from the tariff, we get a 5-cent operating profit for every dollar sold, which results in a retail price of $1. For our 10% tariff, that means our product that's imported from China will be $1.07. Will retail for $1.07 to maintain our 5 cents operating profit. And our 25% tariff from Canada and Mexico would result in a $1.17 difference. A 10% tariff doesn't result in a 10% price increase. That is the conclusion, right? Because it doesn't affect the SG&A expenses, and our operating profit still remains the same, so the effect is way smaller than people say. Okay, let's change up the script a bit. What if we want our operating profit margin to be the same? Because now our margin has effectively decreased because our revenue has increased from $1 to $1.17, but our operating profit is still 5 cents. So in this scenario where we maintain an operating profit of 5%, we can see that we have to increase our profit margin, which means we have to increase our retail price. So in this scenario, we increased it from 7 to 7.5, and 17.5 to 18.5. Okay, what about our base scenario? If you remember our base case, I project that the operating margin will increase from about 5% to 8%. So if that scenario were to come true, then all Dollar General has to do is to raise their prices just a tiny bit more. If there's no tariffs on their products with no tariffs, they just raise their prices by 3 cents. And that would pretty much take us to the base case scenario. And the 10% tariff option, any tariffs from China, will be an 11% price increase, and a 25% tariff will result in a 22.5% price increase. So all these numbers are way lower than what people seem to believe, that a 10% tariff results in a 10% higher price where consumers pay. But that's not true at all, right? And I truly believe that Dollar General can raise their prices just a little bit at any time they want, right? And then their operating profit will improve dramatically. The other point I want to say is that not all products are imported. A lot of Dollar General's products, especially its perishable goods, are not imported. For the products that are imported to Dollar General doesn't need to increase the prices of all the products by 11 cents. The other way to think about it is an 11-cent increase in prices of imported goods could mean that the Dollar General increases $1 for 1 in 10 items. It just has to be an average of 11-cent increase, but they can choose which products get a $1 increase or 50-cent increase and can leave some products untouched, right? So they don't have to make a profit on the same amount of profit on every single product. So therefore, for the consumers, they might not notice at all because only 1 in 10 products are seeing a $1 increase. So depending on how the Dollar General approaches these price increases, we might see consumers might not notice at all. And I really think that this is a main thesis of why I believe Dollar Generals, why I believe these margins will stick around. I believe they will recover, and I believe the stock price will quickly recover after that. So I believe now is a great time to get in. Maybe there's a chance that a bear case scenario plays out where margins do not improve at all. But even then, our downside is very small. So anyways, that's why I'm investing in Dollar General. I hope you enjoyed the video, and we're going to keep beating the index. All right, thanks for watching, and I'll see you in the next video.